Arnold Segawa sat down with Tao Zhang, Deputy Managing Director of the International Monetary Fund, ahead of the 10th BRICS Summit, which kicks off tomorrow. He asked him about some of the IMF's prescriptions in addressing the status quo, given the capital outflows seen in emerging markets.
The capital flows in and out based on the global financial and economic conditions. Now we are in a period of, as you see, the monetary policy entered into a period of normalizations. Some countries already started, some others maybe followed on its suit, on its way. So we did see some monies flowing out of the emerging market during recent months and even early this year. So what the country, particularly emerging markets, is supposed to do? And of course, at the IMF, we always tell our member countries that you have to make your macroeconomic fundamentals right. That's the first line of the defense. And of course, other tools, you have to make sure your macro framework is resilient enough, is flexible enough, including, for example, flexible exchange rate. These are the things are sort of play the crucial role to that. And of course, there are other measures, for example, macroprudential measures, or the terminology called the capital management measures. So these are the things can be used when other things will not be enough to address the problems. For example, when you are facing imminent crisis caused by the capital outflows, then you have to think about whether or not you can impose what the so-called CFM, the capital flow management measures. So these are the things we're saying that CFM can play the role, but it should play the complementary role to support other measures together with, for example, macro economic policy framework, and it's particularly in terms of those measures to support the flexibilities and the resilience.
Right. In your speech here at the BRICS, you actually do highlight something that we've all been going on about, the demographic dividend in sub-Saharan Africa. And you do highlight that by 2035, we're going to be seeing 110 million more workers come to the workforce. This is just a few years away. And this has me thinking, is it time for us to rethink monetary policy as much of sub-Saharan Africa and emerging markets to maybe look at the Fed's dual mandate as opposed to a single mandate that all of us have been going on about? Maybe for our viewers who might not know the difference, one just looks at price stability, the single mandate, and the dual mandate looks at both price stability, of course, inflation, and on the other hand, employment figures. Is it time for us to rethink monetary policy to address the demographic dividend and the youth that are coming to the workforce?
Okay, that's even, of course, more challenging questions. But certainly, the countries in these regions, they're facing different conditions. But overall, like you said, this part of the world have the advantage of the younger populations, and also plus, of course, the rich resources. These certainly provide the opportunities or potentials for stronger development. But also, this also impose the challenges. And for example, the younger populations, you have to provide enough or adequate job opportunities for them. So that is pretty much the challenges. So these are the challenges facing not only by monetary authorities, but also by fiscal authorities, and particularly by authorities who are pursuing structural reforms. These are how to build your labor market, or how to make your populations more educated. And so there's a wide range of the structural policies in the pipelines. So I wouldn't think the monetary policy or monetary authorities alone could address all of these problems. But certainly, for those countries facing, the increasing challenges for the younger populations or population growth, they have to think very hard how to address these emerging issues, basically turn this opportunity into realities.
Right. My final question, it might be very unfair for me to swing you to the fiscal end, being a monetary man yourself, but it's only fair. Let me just go for it. By 1995, we saw close to just 1/3 of much of sub-Saharan Africa making that 13% tax to GDP ratio. Fast forward to today, the IMF is predicting, well, the numbers are saying that this number is now at 2/3, which is progress being made, yes. But again, that leaves me wondering, much of this is the informal sector. Should we let the informal push for the informal sector to be taxed, or should we give them more breathing space to actually get to that space where they are actually contributing more to the economy?
I think these issues can be, in our view, can be approached at least from two aspects. One is, of course, in the formal sectors, and you have to strengthen the revenue mobilization effort, which basically means increasing the transparencies and put it into a better regulated framework to do it. On the other hand, the informal sector, many of the low-income countries or developing countries, they do have the informal sectors, and you have to make sure these sectors are, in a way to, first of all, create the conditions so that these informal sectors can somehow become formal. On the other hand, the informal sectors depend on who they are. For example, shadow banking, that could impose the potential, the risk because they are in the shadow. But many of the developing countries, if you totally relied on formal sector or formal financial sectors, then you wouldn't achieve the maximum impact of the financial inclusion. So there's a, delicate a balance you have to strike. But the purpose is you have to maintain the bottom line of financial stabilities at the same time to maximize your scope of the financial inclusions. So just using the financial sector as examples. So basically two ways, two-pronged sort of approach to address it.